Tonight, I want to talk to you about something that's moving fast and confusing a lot of people right now. Now, I'm going to speak in the way I always do, through principles, through cause and effect, and through how the machine works. Because if you understand the machine, you stop reacting emotionally, and you start positioning intelligently. Let's start with the big picture. When markets enter a phase of uncertainty, people stop thinking like optimists and start thinking like survivors. This is the moment when the psychology of investing changes. During normal times, investors chase growth, innovation, and momentum. They want the biggest returns, the hottest stocks, the fastest rising crypto, and the most exciting opportunities. But when uncertainty increases, whether due to inflation, geopolitical tension, elections, banking stress, or sudden crashes, the market shifts from greed to fear. And fear has a very predictable pattern. It pushes money away from risk and towards safety. This is what we call a flight to safety. And it's one of the most consistent behaviors in financial history. A flight to safety happens because people don't just lose money in unstable markets, they lose confidence. And when confidence starts cracking, the entire system feels different. Investors begin asking new questions. They stop asking, how much can I make? And start asking, how much can I lose? That one change is enough to move billions of dollars across markets. It's also why you often see certain assets suddenly rise while others collapse. It's not always about the asset's fundamentals in that moment. It's about perception of safety. Safety becomes the most valuable thing in the market. Gold and silver benefit from this psychology because they have been trusted for centuries. They are not a company, so they don't go bankrupt. They are not a government, so they don't default. They are not a bank, so they don't face liquidity runs. They are not a currency that can be printed endlessly. They are physical assets with limited supply, and that scarcity gives them a unique position during uncertain times. When people feel the system is unstable, they instinctively move toward what cannot be easily manipulated. That's why gold is often called the ultimate insurance asset. You don't buy it because you expect it to outperform every year. You buy it because it holds value when everything else becomes questionable. Silver has a similar role, but it behaves differently because it has a dual identity. It's a monetary metal, like gold, but it's also an industrial metal. That means it has demand from both investors and real-world industries. So in certain periods, silver can move even more aggressively than gold. When fear rises and industrial demand remains stable, silver can surge fast. But it can also drop hard when markets panic because it is more volatile. That's why silver often looks weak before it looks powerful. It underperforms quietly, then suddenly explodes when the cycle turns. This is a pattern seen repeatedly across decades. Now, the key point is that a flight to safety is not just about fear, it's about trust. Markets are built on trust. Stocks are based on trust that companies will grow and profits will rise. Bonds are based on trust that governments will repay. Currencies are based on trust that the issuing country will manage its money responsibly. Crypto is based on trust in technology, networks, and adoption. But when trust starts weakening, the system becomes fragile. And when people don't know who to trust, they return to what history has already tested. Gold and silver represent that history. They don't require you to trust anyone. They simply exist. This is why in many major crises, gold and silver tend to become stable or rise while risk assets collapse. During a financial crash, people sell what they can sell quickly. They sell stocks, crypto, high-growth investments, and anything leveraged. The goal is to raise cash and reduce exposure. At the same time, central banks and governments often respond to crises by injecting liquidity, cutting rates, or printing money. And when markets anticipate those responses, gold and silver get even stronger because they protect against the long-term effect of money printing, currency debasement. In other words, even when markets fall, gold and silver are often supported because people expect the system will eventually respond by creating more money. A flight to safety also happens when interest rates and inflation create stress. When rates rise, debt becomes expensive, companies struggle. Governments face higher debt servicing costs, consumers feel pressure, growth slows. This creates an environment where investors become cautious. They reduce exposure to risky assets and move into assets that preserve value. Gold and silver don't produce income, but in times when people fear inflation or currency weakness, preserving purchasing power becomes more important than earning yield. That's why precious metals can outperform in certain high inflation or late cycle environments. What makes this moment especially interesting is that many investors believe Bitcoin would behave like gold in stress periods. They believe Bitcoin would become a safe haven. But the market is showing something different. Bitcoin is still being treated as a risk-on asset, meaning it rises when liquidity is easy and falls when liquidity is tight. That pushes even more attention toward gold and silver because they're doing what safe assets are supposed to do, holding up when fear spreads. So when we say a flight to safety has begun, it means we are watching capital reposition itself. This is not a small move. It's a structural change in investor behavior. It's a shift in priorities. And once that shift begins, it often continues until the uncertainty is resolved or a new confidence cycle starts. Until then, gold and silver remain in focus because they represent stability, scarcity, and survival in a world where too many things suddenly feel fragile. When a major political figure publicly signals support for gold, ND silver, it's important not to treat it like casual commentary. In markets, words from powerful people are not just opinions, they are signals. And signals shape expectations. Expectations move capital. Capital moves prices. That's how the machine works. So when Trump signals support for gold and silver, the real question is not whether you agree with him politically. The real question is, why is this message being pushed now? And what does it tell us about the environment behind the scenes? First, understand something basic about politics. Politicians rarely speak about assets unless it benefits them strategically. Gold and silver are not like stocks, where politicians can easily sell a growth story. Metals represent something deeper. They represent distrust in the system, fear of inflation, and fear of currency debasement. When a politician starts talking about gold and silver, it often means they are trying to connect with the part of the population that feels the system is failing them. It's a message that says, I understand your concern about money losing value. I understand your concern about debt. I understand your fear that the dollar is being weakened. Whether the politician actually intends to protect purchasing power is a separate question, but the message itself is designed to tap into a real emotion, loss of confidence. Trump's style is also important here. He communicates in simple, powerful themes. He focuses on strength, control, and protection. In a time when inflation, debt, and economic uncertainty are rising, gold and silver fit perfectly into that narrative. They are symbolic assets. They represent real value and real money. So when Trump signals support for them, it can act as a psychological anchor for millions of people. It reinforces the idea that precious metals are not just for traders, they are for protection. And when a large population begins to believe that, the demand becomes more persistent and more powerful than short-term speculation. Second, Trump's signal also matters because it increases the probability of future policy shifts. Markets don't move only on what is happening today. They move on what people believe will happen tomorrow. If investors think Trump could influence future economic policy, whether through currency policy, trade policy, central bank pressure, or fiscal policy, then his words become part of the forward-looking narrative. And that narrative matters most during uncertain times. For example, if markets believe a future administration might push for lower rates, larger spending, or aggressive economic stimulus, then investors may anticipate higher inflation risk or higher debt expansion. That expectation alone is enough to increase interest in gold and silver. Third, the timing of this signal is critical. The global system is under pressure. Debt levels are extremely high, not only in the United States, but across the developed world. Interest rates have been elevated. Inflation has been difficult to control, and geopolitical tensions have increased. This combination creates a fragile environment. In such an environment, even small political signals can create large market reactions because the system is already sensitive. When trust is stable, markets ignore most political talk. But when trust is unstable, markets listen carefully. So Trump's signal is not powerful because it is Trump alone. It is powerful because the environment is already primed for a shift toward hard assets. Another important point is that gold and silver are not just investor assets anymore. They are also strategic assets for nations. Many countries have been increasing gold reserves over the past years, especially as the world becomes more divided. When international trust declines, countries prefer assets that are not controlled by another country's banking system. Gold becomes the neutral reserve asset. So when a U.S. political figure talks about gold, it also intersects with global reserve dynamics. Investors notice that. They understand that gold is not only a hedge against inflation, but also a hedge against geopolitical fragmentation. Now, let's talk about silver specifically. When politicians mention gold, silver often follows because silver is historically connected to monetary systems. Silver has a lower price per ounce, which makes it psychologically accessible to the public. Many ordinary investors cannot buy large amounts of gold, but they can buy silver. That makes silver a people's metal. So if Trump's messaging encourages a populist shift toward hard assets, silver can benefit strongly because it becomes the entry point for mass participation. This is why silver can sometimes move explosively when the narrative shifts. It's not only institutions, it's also retail demand. Finally, Trump's signal can influence sentiment at a time when Bitcoin is melting down. Many investors who believed in the digital gold story are being shaken out by volatility. When that happens, people search for something more stable. A political signal supporting gold and silver can accelerate that shift. It becomes a permission structure for investors to rotate out of speculative assets and into metals. It doesn't mean Bitcoin is finished forever, but it does mean that in this phase, the market is reprioritizing stability over innovation. So the real takeaway is this. Trump's signal is not just talk. It's a reflection of growing public anxiety about money, debt, and the future. It is political messaging, aligned with a deeper economic reality. And when politics and economic fear align, gold and silver often become the winners, because they represent the oldest form of financial trust when the modern system feels unstable. When people hear the phrase gold and silver price floor, they often misunderstand it. They imagine a guarantee, like a wall under the price that cannot break. But markets don't work like that. There are no permanent floors. There are only zones, areas, where buying pressure becomes strong enough to slow down declines and in many cases reverse them. A floor is not a promise, it's a behavior. It's the point where enough participants decide, this is cheap enough, this is safe enough, and I want to own it. So when we talk about gold and silver forming a floor, what we're really describing is a shift in psychology and positioning. It's the moment when investors stop selling metals and start accumulating them. It's the moment when the weak hands exit and the strong hands step in. And that transition usually happens when the macro environment changes in a way that increases the long-term value of scarce real assets. Historically, gold forms a floor when inflation fears return, when the currency weakens, or when the market senses that the central bank is trapped. Think about the structure of the system. Most modern economies are built on debt. Debt is manageable when rates are low and growth is strong. But when rates rise or growth slows, debt becomes a burden. Governments and central banks then face a painful trade-off. If they keep rates high to fight inflation, they risk recession and financial stress. If they cut rates to protect growth, inflation can return. Either path creates uncertainty, and uncertainty is what drives demand for gold and silver. A gold floor often forms when investors begin to believe that the next phase will involve more money printing or financial repression. Financial repression is a polite term for policies that reduce the real value of debt, usually through inflation, low real interest rates, or currency devaluation. It's a strategy governments use when debt levels are too high to pay down normally. Instead of paying the debt in hard money, they pay it back in money that is worth less. This has happened many times in history, and markets recognize it. When investors sense that this is the direction, they move toward assets that cannot be printed. Gold is the cleanest example of this. It is scarce, globally recognized, and historically trusted. But silver is where things get more dramatic. Silver has the same monetary characteristics, but it also has industrial demand. That means silver has two engines. One engine is fear and monetary hedging. The other engine is real-world usage, electronics, solar panels, medical applications, and many other industries. When both engines start pushing in the same direction, silver can rise far faster than most people expect. And because silver's market is smaller than gold's, it can be more sensitive to demand shifts. That's why silver often feels quiet for long periods and then suddenly explodes upward in short bursts. Now, the floor doesn't form just because people like metals. It forms because metals become attractive relative to other options. For example, if stocks are overvalued, if bonds are risky due to inflation, and if crypto is collapsing, then the relative appeal of gold and silver increases. In other words, a floor is often formed not just by metals being strong, but by other assets becoming weak or unstable. Capital is always rotating. Money is always moving from one place to another. So when the market loses confidence in risk assets, it searches for alternatives. Gold and silver become those alternatives. There is also another layer, central banks. Central banks are not retail investors. They don't trade for excitement. They accumulate gold as a strategic reserve. When central banks are buying gold, they create long-term demand that doesn't disappear easily. This institutional demand can act like a stabilizer under the market. And when the public sees central banks accumulating gold, it reinforces the narrative that gold is becoming more important again. That narrative itself can create more demand. The idea of floor also connects to technical market structure. Large investors often place buy orders around key levels. If enough buying interest exists in a zone, price begins to stabilize. Then, once stability is established, the next phase begins. Short sellers cover, momentum traders re-enter, and the market builds a base. That base is what people later call the floor. But it's not magic. It's a result of positioning. So when people say gold and silver are building a floor, they are describing a market that is beginning to treat these metals as essential again. It is a shift from speculation to protection. It is the recognition that the system is under pressure, that debt is high, and that the future may require more monetary easing. In that environment, gold and silver don't need hype. They don't need promises. They simply become the default hedge. And when that happens, the floor forms, not as a guarantee, but as a collective decision by the market to own real value in uncertain times. For years, Bitcoin has been promoted as digital gold. The argument sounds simple and convincing. Bitcoin has limited supply, it cannot be printed, and it exists outside the traditional banking system. So many people assume that when the financial system becomes unstable, Bitcoin should rise the way gold rises. But what we are seeing now is a very important reality check. Bitcoin, at least in this phase of the cycle, is not behaving like a safe haven. It is behaving like a risk asset. And understanding that difference is crucial if you want to avoid getting emotionally trapped in the narrative. A safe haven is an asset people run toward when fear rises. A risk asset is something people sell when fear rises. Bitcoin is currently in the second category. This doesn't mean Bitcoin has no future. It doesn't mean it cannot recover. But it does mean that the market is still treating Bitcoin as part of the speculative ecosystem, not as a stable store of value during crisis. The first reason is volatility. Safe havens are trusted because they are stable. Gold can be volatile, but compared to Bitcoin, it is far more stable. Bitcoin's price can drop 10%, 15%, even 25% in a short time. That level of volatility makes it psychologically difficult for large institutions to treat it as protection. In a real crisis, the first thing big money wants is stability. They want to know that if the market collapses tomorrow, their hedge will not collapse even faster. Bitcoin has not yet proven that it can consistently play that role. The second reason is liquidity cycles. Bitcoin is highly sensitive to liquidity. When money is cheap, interest rates are low, and central banks are injecting liquidity, Bitcoin tends to rise aggressively. That's when risk-taking is rewarded. People borrow money, leverage increases, and speculative assets outperform. But when liquidity tightens, when rates rise, when credit becomes expensive, when risk appetite falls, Bitcoin often drops hard. This is exactly how growth stocks behave. This is why many professional investors treat Bitcoin more like a high beta tech asset than like gold. The third reason is leverage. Bitcoin markets have a strong leverage culture. Futures, options, margin trading, and high-risk derivatives are extremely common. Leverage makes markets fragile. It creates a chain reaction effect. When prices drop, liquidations trigger. Liquidations create more selling. More selling causes more liquidations. This can turn a normal decline into a waterfall crash. Gold markets have leverage too, but Bitcoin's leverage is often more extreme and more reactive because the market is younger, less regulated, and trades continuously. The fourth reason is the investor base. A large portion of Bitcoin holders are not conservative investors. They are traders, speculators, and retail participants chasing high returns. This creates a different kind of market behavior. When fear rises, these participants don't calmly hold. Many panic sell, especially if they entered near the top. In contrast, gold ownership includes central banks, long-term institutions, and people who buy it specifically for stability. That creates a more resilient base of demand. The fifth reason is that Bitcoin still depends on confidence in technology and networks. Gold is a physical asset. It does not require electricity, internet, or an exchange. It does not require a wallet or a private key. It is universally recognized and can be held outside the financial system completely. Bitcoin is decentralized, but it still depends on digital infrastructure. In a normal crisis, that may not matter, but in deep uncertainty, many people prefer what feels tangible. That's why gold continues to win during certain fear-driven cycles. Another major factor is correlation. Bitcoin has often moved in the same direction as stocks, especially tech stocks. When stocks rise, Bitcoin rises. When stocks fall, Bitcoin falls. This correlation is a problem if you want Bitcoin to be a hedge. A hedge must behave differently from the assets you are trying to protect against. Gold often provides that diversification. Bitcoin so far has not consistently provided it. Now, none of this means Bitcoin cannot eventually mature into a safe haven. It might. Over time, if volatility decreases, if institutional adoption becomes deeper, if leverage reduces, and if Bitcoin proves itself through multiple crisis cycles, then it could behave more like digital gold. But that is not where we are today. Right now, Bitcoin is still in the stage where it is treated as a high-risk, high-reward asset. And that's why during this current stress phase, as gold and silver stabilize, Bitcoin is melting down. The market is reminding everyone of a key principle: narratives are not reality. Reality is behavior under pressure. When pressure rises, Bitcoin behaves like a risk asset. Gold behaves like a store of value. And silver, because it combines monetary and industrial demand, becomes the wild card that can surprise the most people. So the lesson here is not to hate Bitcoin or worship gold. The lesson is to understand what each asset truly is in the current cycle. In markets, you don't win by believing stories. You win by understanding how the machine behaves when conditions change. And right now, the machine is telling us clearly when fear rises, capital is flowing toward metals, not toward crypto. Most people think markets move because of headlines. They think markets move because a politician spoke, because a report came out, or because a big investor tweeted something. But if you look at markets from a deeper, more structural perspective, you realize something. News is often just a trigger. The real driver is liquidity. Liquidity is the fuel that makes the market engine run. And when that fuel is abundant, almost everything rises. When that fuel is scarce, almost everything struggles, especially the most speculative assets. This is why understanding liquidity is one of the most important skills in investing. Liquidity is simply how easily money flows through the system. It's the availability of credit, the cost of borrowing, and the willingness of institutions to take risk. When liquidity is easy, people borrow more, invest more, and speculate more. When liquidity is tight, people pull back, reduce exposure, and protect what they have. This isn't just psychology, it's math. If borrowing costs rise, leveraged positions become expensive. If credit becomes harder to access, companies struggle to expand. If risk-free yields become attractive, money moves away from speculative assets. All of this changes asset prices. The reason liquidity matters so much is because modern markets are built on debt. The global economy runs on credit. Businesses borrow to grow. Governments borrow to spend. Consumers borrow to buy homes and cars. Banks lend money to generate profit. And investors use leverage to amplify returns. This creates a system that performs beautifully when rates are low and liquidity is abundant. but it becomes fragile when rates rise and liquidity tightens. That fragility is exactly what we are seeing now. When central banks raise interest rates, they are not just fighting inflation. They are also draining liquidity from the system. Higher rates increase the cost of borrowing, reduce lending, and make holding cash more attractive. This causes money to leave risky markets. And the first assets to suffer are the ones that depend most on easy liquidity: high-growth stocks, speculative tech, and crypto. Bitcoin is one of the most liquidity-sensitive assets in the world. It can rise dramatically when money is cheap, but it can also collapse quickly when liquidity tightens. That's why Bitcoin often behaves like a lever on global liquidity conditions. Gold and silver behave differently because they are not dependent on the same liquidity dynamics. Gold especially is often viewed as a hedge against the consequences of central bank actions. When markets believe central banks will eventually have to reverse course, cut rates, print money, or inject liquidity, gold becomes attractive. It is a hedge against the long-term outcome of debt problems. So while liquidity tightening can hurt many assets, it can simultaneously increase the appeal of gold, because gold is insurance against the system itself. This creates a very interesting situation. In the short term, tightening liquidity can cause broad market weakness. In the medium to long term, the fear that tightening will break something can push investors toward gold and silver. In other words, gold can be supported even when liquidity is tight because the market anticipates what comes next. And what often comes next in a high debt world is policy reversal. The reason policy reversal becomes likely is because governments cannot tolerate prolonged high interest rates when debt is massive. Debt servicing becomes too expensive. If rates stay high, governments face rising interest payments, deficits expand, and political pressure increases. At the same time, high rates can slow the economy, increase unemployment, and reduce tax revenue. That creates a cycle where the system begins to strain. Central banks then face a dilemma. They want to control inflation, but they also want to avoid a financial crisis. This is the trap. And in a trap, central banks usually choose stability over discipline. They eventually provide liquidity again. They cut rates, create new programs, and support markets. This is not because they are evil or incompetent. It's because the system is designed in a way that requires liquidity to survive. That's why gold is often called a hedge against central banks. Not because gold rises every day, but because gold performs well in the environment where the central bank is forced to print. Silver becomes even more interesting under liquidity dynamics because it sits between two worlds. It benefits from monetary fear like gold, but it also depends on industrial demand. If liquidity tightening causes economy, I see slowdown, industrial demand can weaken, which can temporarily pressure silver. But if the market anticipates a future liquidity wave, stimulus, rate cuts, money printing, silver can explode because it reacts strongly to both monetary and industrial cycles. This is why silver often lags, then suddenly leads. So when you hear liquidity is the real driver, it means this: the biggest moves in markets are not random. They are the result of how much money is available, how expensive it is, and how willing people are to take risk. Trump's comments may be the headline, and Bitcoin's meltdown may be the drama, but the deeper engine is liquidity tightening and the market's anticipation of the next policy shift. If you want to understand where markets go next, stop watching only the headlines. Watch liquidity, because liquidity is the invisible force that decides whether risk assets soar or collapse, and whether gold and silver become the ultimate winners in the endgame of the debt cycle.